Great to see you again. Lovely morning.
Great to see you too. Good to be here.
As a quick reminder, everyone, I am Marcus Schafer, Greenspring's Director of Growth. This is Pat Collins, our CEO, and we are back to pick up on a conversation we had last time. The conversation we had last time is looking at real estate. Is your house an asset? Is it a liability? Is your house consumption? Or is it investment? And when we think back to that conversation, I think one of the big surprising things that came out of it was the really low return expectations for real estate after inflation. The research shows it's about 1% after inflation for price appreciation for real estate, which I think begs the question, is real estate a good investment when it's outside of your house? So things like rental real estate. And we thought it'd be really, really helpful for us to dive into that question and how we look at it at Greenspring. About 10% of our clients do have this as an individual investment they're invested in. So it's really common when you think about the type of people that we work with. And we just thought it'd be helpful to look through it.
Yeah, I'm excited to dive into this topic. It's, as you mentioned, we have well over 100 clients that invest in rental real estate and other types of real estate properties. So it's a question we get all the time, and we've done a lot of analysis, a lot of thinking through this. We're excited to share kind of hopefully our best thinking on this topic and give people some insights if you're thinking about either converting maybe a property you own as a personal residence to a investment property, or buying a property outright and renting it out. So excited to get into this.
Yeah, let's jump into it. So I kind of led with 1% real returns, which again means returns after inflation. And then when you compare that number to what you see in kind of the public market equivalent, the PME, so these are publicly traded REITs, real estate investment trusts, and we tend to see after inflation returns of about 5 or 6%. So significantly more than just the price appreciation. Where's a lot of that difference coming from? A lot of that difference is coming from the fact that you're receiving income. Real estate investment trusts have to distribute 90% of their income. So it's kind of the rents, if you will, that are being kicked off. And I think that's one of the really attractive things why people evaluate directly held real estate, is this idea of kind of passive income being kicked off from the portfolio. And then building off that, what may be return expectations? I guess this question for you, Pat. Would you expect, or do you think investors expect, for targeting directly held real estate?
Yeah, it's a great question. I don't know. I think in working with clients over the last 20 plus years, I'm not sure if a lot of clients think through that question, which is a really important one. I think if you were to ask them, or at least if you were to ask me what your expectations would be, I would think with an illiquid asset that has highly concentrated risk, I'd want to have returns higher than equities. Personally, publicly traded, liquid investments, expected returns I'd want to have. But in fact, I think almost every analysis we do on residential rental real estate, we tend to see expected returns to be a bit lower. Now, the other side of that is that I think real estate probably as a general rule has a little bit more stability in price kind of movement. You typically don't see every 5 years, 20 or 30% pullbacks in real estate, where you could see that in stocks pretty regularly. But it has happened, and the illiquid nature of it, I think, is something to consider. But I do think when we kind of dig into it, what we're looking at is typically expected returns in the 5 to 8% range would be a good, solid return on residential real estate.
Yeah. You bring up great points around certain risks. Anytime you go concentrated, I view that as a bad signal for higher risk. Well, we're going to dive into those numbers, how we think about building assumptions, how we think about assumptions on the inputs, assumptions on the outputs. Maybe let's start with why people invest directly in privately held real estate. And what I mean by this is certain aspects that are unique to individuals that maybe this makes a little bit more sense. And one of the things, I guess it's a question I always ask myself when I'm thinking about investing is, do I have any specific skills or attributes that nobody else has that I am bringing to the table? Am I just bringing my capital, or am I bringing something unique? And I think this is one of the reasons why we see many individuals kind of first dip their toes into this, because they might be bringing something unique to the table that nobody else has. So maybe just talk about some of the reasons why you see people getting into this.
First and foremost, I think a lot of times people get into it because it's something they feel like they know, they can touch, they can feel it, they can see it. It doesn't feel like stocks do to many that haven't invested before. Stocks might feel a little bit more like gambling, or really risky. And in their mind, gosh, how much can I lose in real estate because I own this property? I can go look at it or go walk into it every single day. So I think that might be the beginning point part for a lot of people. But there are some attributes of real estate that are just different than investing in a portfolio of stocks and bonds that are worth thinking through. So the first is that real estate allows for leverage in a way that's just so different than stocks and bonds. Yes, you can use leverage to buy stocks and bonds, but not to the extent of real estate. In many cases, you can buy real estate for almost 100% of the value by just basically getting a loan. So nobody that I know of are going to loan you 100% of the value of a stock portfolio for you to go buy a stock portfolio. And on top of that, you have all sorts of things like margin calls and things like that people get scared of with stocks. So I think that's a big part of that is you can use other people's money to buy real estate, and that can be attractive. Now, it's been really attractive over the past several years because interest rates have been so low. You might be able to buy a real estate property for 3% or less. Now, that's changed here recently where the lending rates are 6-7%, could even be higher depending on the type of property. If you're buying an investment property versus a personal residence. So I think but I think that's a really important distinction is that you don't need much money to buy real estate. And compared to building $1 million stock portfolio, you got to work a long time, you got to save a lot. You could do that over the course of a few years if you have a good enough income because banks will lend to you basically.
Yeah, which we'll talk about later, the boom bust cycle of real estate. If it's easier to get into, it's easier to get a bunch of leverage into, tends to be more speculative in nature. One of the things you mentioned there is just the change in mortgage rates. And that presents a lot of opportunities where you might have an existing property at a really low mortgage rate. In a sense, that might be one of your greatest assets, right? Because it's really tough to give up a 3% mortgage rate in exchange for a 7% mortgage rate. And so you might look at that and say, hey, does this lower cost of financing give me a competitive advantage in the industry that other people don't have? That could be one thing that a lot of people are looking at saying, hey, I have this low interest rate. And it's especially true right now, but I think it's kind of always one of these components, right? Hey, I have really good credit. Well, I can lend to somebody that doesn't have that great a credit, right? I can rent to somebody that doesn't have that great a credit. So there's that kind of interest rate arbitrage in a sense that might be going on as one of the reasons.
Yeah, for sure. Absolutely. And I think there's a few others that I would touch on. One is there's some tax benefits investing in real estate that you don't get with investing in other types of investments. And we're going to dive into all of these different things a little bit later. But I do think that's a big factor is the tax code really kind of encourages real estate investments. You can see, you look at a lot of wealthy people and a lot of people have made their money in real estate. And one of the key attributes there is when you look and see how much they pay in taxes, it's not that much because they are figuring out ways to shield their income from tax. They're looking at ways to defer gains on properties. There's a lot of different factors there. So I think it's just another aspect of real estate that you're not getting with stocks or bonds.
Yep. Yeah, I think that's a great point. I'll just name a few other ones we thought of when we were brainstorming. One is you're also viewing real estate investing as an occupation, right? And maybe hobby is appropriate, maybe landlord is appropriate, but you're thinking, hey, I have excess time and a willingness to do things. I might have handyman skills. I might have just an interest and some excess capacity where, hey, why not use my money and also use my time and my energy, right? I'm willing to take on headaches that somebody else doesn't want to take on, which is why they're renting. So that could be one. And then also I know of, in today's marketplace where you've seen a ton of price appreciation in real estate, it makes owning a home for the next generation much more difficult. So we've also seen a lot of parents thinking about holding on to houses and property in a way to make sure their kids have a chance to live in kind of similar lifestyles to how the parents grew up.
Yeah, absolutely. I think when we're thinking about real estate, and I think as we talk through in this podcast, there's probably two different ways people I've seen invest in real estate for residential investment. So one is, or maybe on one extreme, you have just a pure buy and hold. I'm buying a property, I'm going to rent it out, I'm going to collect the rent from it, and hopefully over time I'm going to get both rent and appreciation on this property, but I don't really have an intention of selling it. I really am buying this as an income producing investment. And then on the other side, you have what I would call maybe more value add type investors that are going to buy a property, hopefully at a cheap price, fix it up. And that's kind of where your sweat equity, kind of the time, energy, resources that they may have could go into it. I'm going to fix this property up, and then I'm going to sell it. And the amount I put in plus what I paid for it is going to be less than what I can sell it for. And that appreciation is what I'm kind of after. And then you probably have somebody in the middle who buys the property, fixes it up, then rents it out and plans to hold it. So there's kind of variations of those, but I would say that's probably the two or three most common ways we've seen people invest in real estate. Obviously, there's other things you can do, like a straight buy and hold for appreciation. If you see there's going to be development coming into one area and you say, oh, I'm going to try to buy some properties ahead of that. I rarely see that. That's more speculative, but that's also a possibility too.
Yeah. That's great. Let's talk. So we talked unique advantages. Let's talk some of the risks about investing in real estate. And you kind of, I think, referenced one, which is real estate. You invest in what you know. That also, to me, when I'm evaluating this, when you invest in what you know, you tend to increase your concentration because what you know tends to be very geographically concentrated. And there's been studies out there where people tend to buy more individual stocks closer to where they live. They know it, right? This is kind of like a common thing you'll see, invest in what you know. Well, what that means is you're kind of piling on your concentration risk to very specific markets, right? You kind of think, hey, where do I live? That's where my job is. Well, let me just add some additional net worth concentration right there. And I think that's one of the things you have to be really cautious of is, are you adding too much geographic specific risk to your total portfolio by adding real estate?
Yeah, this one is sometimes hard to see when you're in the midst of it because it's kind of like the boom and bust nature of it. But I think there's examples even today. We live outside the DC area, and with a lot of the job losses happening, you could have lots of people looking to move out of DC. DC tends to be a transient type area. People come in to work for the government, but if all of a sudden there's large job losses, you can see people leaving. You can see property prices really dropping because of supply and demand factors. There's another story that comes to mind with this. I have a client who invested in real estate in North Dakota, and it would be an interesting place, given that you live on the East Coast, to invest there. But years and years ago, they started this kind of boom around fracking, and there was a lot of oil that was found there, and they were figured out ways to get out of the ground. Well, it created all sorts of opportunities for people having to move there to work on these kind of, these rigs and whatnot. And they needed places to stay. They needed places, for restaurants, for offices. I mean, all sorts of different services and facilities had to come out there. And so, he kind of lived through a boom and bust period. And it was really interesting to see. It was so specific to the price of oil is what drove, in a lot of cases, real estate, because when the prices got too low, they couldn't make the numbers work for drilling. So all of a sudden people left. And when the prices got higher, they all came back and they all needed rental places. It's just that's probably an extreme example of being kind of a boom bust. But I think anywhere you're investing, you do have to be careful of, is there any factor that could happen that would cause people to want to leave, or the other way, it could work in your favor. But I do think those things are hard to see sometimes. Most people don't think that there was going to be massive job cuts to the entire federal sector, but yeah, it happens.
Yeah, this is the This is the thing about risk. It's always there, but you never see it, right? And a reason why we call them risk factors, because it's really tough, beyond the fact that we know there's an amount of risk, to understand what is the actual underlying risk, and then how do I build something that hedges against that. Super, super tough to do. But you also kind of alluded to another, I think, unique aspect about direct invest in real estate, and that's illiquidity, right? Because you were talking about boom and bust. Not really that big of an issue if you could sell like this, like you can in a mutual fund or an ETF or a single stock. But when you think about individual housing, it tends to be much more, there's a time horizon, how long it takes to sell. There's just a lot more hurdles to getting your money out, putting your money back in to play. You think about transaction costs. So I think that's something that I would think really, really long and hard about. Is this money is not easy to access. And sometimes that's a good thing for certain people, but oftentimes it's not a great thing.
Yeah, I've had more instances of this illiquidity issue come up over the years than I care to admit this with clients, because it's hard to watch. A few things on this. Obviously, you're making assumptions when you buy a property that you're going to have a renter in there. That person's going to rent out the property for some set amount of income, is not coming in because maybe you're having a hard time leasing it out, or there's massive repairs that need to get done, and that means that you can't have anybody in there while those repairs are getting done. There's still costs associated with the property at that time. So you still have, if you have a debt, if you have mortgage, you still have your mortgage payment, you still have taxes, you still have insurance, you still have utilities that you have to pay. And so all these things just add up. And obviously, depending on your personal financial situation, it could be really, really detrimental from the standpoint of having negative outflows with no liquidity. And then, on the other side of it, let's say you've had it for a long time and you have a lot of equity in the house. Well, there's also risks around, well, could I pull that equity out if I need to at some point in the future for liquidity? A lot of times that's the kind of conversation that people have. Well, yeah, I can't sell it, but I could always get a mortgage on the property. I have a lot of equity in it. That's true, but you also have to think about your personal circumstances. I've had situations where clients are looking to take out a mortgage on it, but because of their personal financial situation, maybe they're not working, maybe they lost their job. It's an exact time when they need liquidity, and they go to try to get a mortgage on the property, and the bank says, sorry, I don't know how you're going to pay this back, especially if the renter might leave. So we're just not comfortable giving you a mortgage because you don't have any income. And so these are all things that you have to think through, is that it may not seem like a big deal now, but it's kind of like when that perfect storm hits, could that be a problem? And obviously, when we're talking to clients, we want to think through, what if all these risks line up at the same time? And are we going to be okay? Can we weather that? Do we have enough liquidity outside of the real estate to be able to weather that?
Yeah. And, kind of some of the things you're also alluding to there is risk for an individual property, right? And I think the common example of idiosyncratic risk, or risk specific to one thing, you can diversify away. It's kind of like the classic story is, if you were a trader from Venice back in the 1500s, you can buy one boat to go and get your goods and bring it back, and you have an expected profit, but there's a risk that that boat sinks. Well, what you could do is, if 10 people are doing the same thing, you can each invest 1/10 in something. One boat might sink, but you still have 9 boats. And so as a whole, you're better off. And that's one of the challenges when you think about direct investing, is you can't as effectively deploy diversification techniques that you can in other aspects of your portfolio. So it builds up this potential that you could have a catastrophic loss or something very damaging that's just not quite the same if you can diversify some of that stuff away.
There's no doubt. And I think what we've seen is, for a lot of our clients that are the most successful in real estate investing, rarely do we see it being very, very successful with people that own one property or two properties. Not necessarily because of the risk, but I agree with you that I think that is something that is absolutely accurate. It's just, I think there's also an element of just getting better and learning. And when you have one property, every time you fail, it's kind of like it really impacts your returns. When you own 25 properties, you can spread some of your costs out over, over all those properties. You learn, you don't make the same mistakes twice. And so it becomes more like a business than it does just an investment that you're trying to manage. Maybe we could talk a little bit about, I think the last thing here, just from a risk standpoint, we were alluding to this and I kind of made some examples of this, but just the boom and bust nature that can happen in real estate. And I think, some of this is tied to leverage. Whenever you use leverage, it amplifies the good and the bad of an investment. So if I'm buying something for 100% debt or 95%, I'm taking out debt for it. The chances that I could get underwater happen very quickly, and that can start to escalate if that happens with a lot of people. So leverage, I think that the time that I'd say, I recall is the 06, 07, then into 08 period. And if people remember that, that was kind of the boom period in real estate. The very beginning of that was kind of the boom period where, gosh, you would turn on the TV and every show was around renovating a house and flipping homes and things like that. And it felt like everybody was getting into that. And, it's always scary when you hear people that have no understanding or knowledge about an investment really going all in on that. And so, I've heard that with technology stocks in 2000. It felt the same way in 05 with real estate. You could make an argument that maybe crypto could have a, similar feel right now. So I do think that oftentimes once something has a really good return for a long period of time, or at least a significant period, some people pile into it and they may not have the right, we're going to get into how we evaluate and analyze things. I'm not sure everybody did that. But again, that's just kind of the cyclical nature of it, is that you can have lots of people, a lot of capital flow into it, and then a lot of capital can leave. The fact that it's highly leveraged as well, people can get underwater really quickly, and that just exacerbates kind of the trend.
Yeah. And, directly related to real estate, when you look at the long run evidence of returns, barely outpaces inflation. And then what you've seen is a dramatic increase in price appreciation very recently, which, now you're always asking the question, can I expect this to continue? Or is this the abnormal time? And how do I think about balancing those trade-offs? And the fact that we probably really, really don't know. So how do you balance that going forwards? It's also, one of the challenging things is when you think about an investment, you really focus on that particular investment. And what we're trying to also do is say, well, it's actually a choice, right? You can choose this investment or you can choose a different investment. And you alluded to this at the very beginning of the conversation, where you want kind of stock market like returns, if not greater. So the other thing we're thinking about is opportunity cost in terms of dollars, opportunity cost in terms of time. And I think that's a really helpful analysis, just to say, hey, you could do this. What else could you do? And then use that to inform your decision and your hurdle rates for which investment you select.
It's a really good point. This one is where I see the biggest issues I see with opportunity costs is less so in the purchase of real estate and more so in the analysis of whether should I keep this real estate property or not. To your point, prices have gone up so much over the last 10, 15, 20 years. And so if rent hasn't gone up commensurately, what that means is that most of your future returns may not be as good, because you're going to need, we'll get into some of the numbers, but the income you're generating from the property as a percentage of the value of the property is actually going down, because property value is going up and maybe rent is not going up as quickly. So when you're doing this analysis, a lot of times, maybe when you purchased the property, it was a pretty good investment. You did the math and you said, I'm going to earn a decent return here. You may have gotten really lucky and the appreciation has gone up significantly over the past, let's say, 10 years. You should probably go back and do that analysis and say, should I expect the same return for the next 10 years that I did the last 10? Because a lot of my return has not come from income, it's come from appreciation. Will that continue? Knowing what the data says, knowing what the history says, at a minimum, even if you do expect the same price appreciation, your income return should be lower, most likely, because the rent hasn't gone up commensurately, if that's truly the case. So I think the opportunity cost is not only at the purchase, but I believe people should be thinking about it each and every year when they're evaluating what's the expected return on this property now, given that the things have changed potentially.
Yes, yeah. And thinking about the real right way to do this, which is incredibly challenging because almost nobody has this data in a format that's easily to do, is what's called a public market equivalent analysis, where you say, I'm going to match my cash inflows and outflows to a decision to buy, sell a public equivalent, right? So you say, hey, I have to put some money into the property. Well, that was actually a choice in that time that you could have done something different. Again, these analyses incredibly challenging, but what you tend to find is the return between what you think you get and what you got narrows down dramatically when you're able to actually get that analysis. And the best place we could kind of see some of that stuff is with private investments. But all this comes to the actual analysis part, right? It's really, really important to think about realistic expectations. So maybe just talk with us around realistic income expectations and how you think about putting those together.
One of the benefits we have at Greenspring is we have so many clients that are real estate developers. And so we've been able to spend lots and lots of time with them over the years, understanding how they look at really big projects that they're getting into. Could be apartment complexes or shopping malls or retail centers or things like that. And I think one of the things that we've learned over time, and you can take that kind of institutional experience and bring it down to how you would evaluate just a single property that you might think about buying. And I think one of the things that we've learned over time is that the underwriting, meaning how you model your investment, is so important. If you look at some of the best investors in the world, as far as how they, and best developers, how they do this, is every single factor and assumption that goes into it, they want to be conservative with it. They want to assume that things aren't going to be perfect, in every single way, because they know they've been in the business a long time. They know how things can go wrong. So whether it be your occupancy rate or your repair costs, or, a lot of times, depending on how you finance the property, you might not get fixed rate debt. You might have variable debt. So what your interest rates are going to be over time. All these different things are factors. We're going to go through some of these factors when you're thinking about building a model to try to figure out what the returns may look like. But I would say the number one is be conservative with your assumptions, be conservative in your underwriting and building this out, because, most likely there's going to be things that go wrong that you can't expect. And there'll probably be some things that go well, but be conservative so that if you can outperform, just returns will be a little bit better. If you can make the model work with conservative assumptions, then you're going to feel a little bit better about buying the property.
Yeah. Warren Buffett, if you listen to some of the stuff he says, he's like, I never really do an in-depth discounted cash flow analysis. That's not what I do, because it has to make so much sense before I even run the numbers. Because if you're trying to make the numbers work, that's the real challenge of the game. And it's realistic inputs. That's something you have to really be thoughtful about. And then it's also, hey, when you get the number at the end of the day, what's the likelihood that you can get this number? And is that number a big enough hurdle over what you could get with less effort to compensate you for the direct invest you're taking? So yeah, you mentioned on the input side, occupancy rates, right? Which is, if it's just a single family home, you really have to think about how often are you redoing your leases, right? If it's every year, there's probably at least a month in between there where somebody's moving and somebody's coming out and you got to do a little bit of repair work. And so that's like almost the most aggressive you could be in that standpoint. And that's not even assuming, hey, what if it lingers on the market and I have to adjust my price?
Probably one of the biggest errors I see is people just say, well, here's what the rent is. It's, $2,000 a month. And that's what they use in their assumptions. And to your point, there will be, I don't know when, maybe not for a year, maybe not for 2 years, but there'll be some period where either Your renter moves out and you need to move somebody in. And even if you have a renter ready to go, they may move out, but you might realize, gosh, I have to make some repairs to the property. The carpet's terrible. We need new paint, whatever it is. And it might mean that for a few months, you need to have some repairs done. You can't have a renter in there. So you should be using some percentage of the expected rent as your occupancy rate. So, typically I tend to see somewhere in the 90% range to be conservative, again, in your underwriting. Moving up, there's a general rule of thumb when you talk to residential real estate investors that they tend to take when they're looking at a very quick, like a Warren Buffett back of the envelope. Let me just take a quick look to see if this works. And it's the 1% rule, which is you take 1% of the value of the property. That should be your monthly rent. So if I'm buying a $500,000 property, as a general rule of thumb, I should be getting about $5,000 a month, 1% of that in rent. And so that's just right off the bat. If you don't see that, I would say it's going to be a little bit more challenging to kind of have a decent return with this property unless there's something else going on that you can kind of point to that might increase your returns.
Yeah. It's a great example of a rule of thumb being incredibly helpful. And then very interesting when you see that rule of thumb start to break down and people start saying, well, it doesn't work in these markets, right? Hey, it doesn't work in San Francisco. You got to use a number closer to half that because values have increased so much relative to the rents you can extract. And the implicit argument there is values will keep increasing so much relative to the rents you can extract, which switches you maybe from you think you're buying income, but what are you really buying? You're buying expected price appreciation. Expected price appreciation disfactored from fundamentals. Another word for that might be speculation.
Yeah, totally agree with that. I think that's obviously the way people think about buying properties, that the income doesn't work. The only other area you're going to make money on is appreciation. Then that is, to your point, speculative. It is much more difficult to predict what price appreciation is going to do in a region or to a specific property compared to, it's a lot easier to predict what my income is going to be from that property. I have a lease. I can look at it for the next 12 months. As long as that person doesn't break their lease, I know what I'm going to be receiving. There's a decent chance that there's a market there that if they leave, I can find somebody else that's going to pay somewhere right around there. Appreciation is all over the board. You have no idea. There's so many things that could impact that.
Yeah. And if I just go back to the income thing, one of the things we were chatting about before, which is income, the more certain you can be about that, right? We were kind of talking about some federal housing programs and why people might want to buy houses targeted to rent out near those, because you have a little bit more certainty. Hey, here's going to be the income for this area. So you have more confidence in the numbers working out. You have more confidence in the fact that you'll get that. You might have a different trade-off and, hey, are you sure you could do the right diligence to get the right tenant in there? But that's something that we do see across our clients, is trying to think about lower property values, higher rents. How do you work on those two factors to get closer to that 1%? And those are the situations that, if your goal is income, tend to be, we see working out on paper a little bit better.
Yep. So I think the second factor, kind of the second thing to think about, so we have income we've talked about, but I think the next thing is all the costs that go into managing a property, and how do you underwrite those? How do you figure out what you should be using for costs? So I'm going to start with a rule of thumb, and then maybe we can get into, I think this one's a little bit more challenging on rules of thumb, but yep. I do think it's just somewhere, again, if you're trying to look at a listing somewhere and do an analysis to say what's a realistic cost, I would say most of the time what I've seen is that cost expectations are somewhere around 50% of the rent. So I'll go back to my example of a $500,000 property. If I have $5,000 in rental income, I should expect, or I could expect, to see costs somewhere in the $2,500 a month range. And again, that probably scales up and down a little bit based on size of property and other HOAs and other different fees like that. But anyways, that's just a basic rule of thumb. So this is going to be things like property management, real estate taxes, insurance, repairs, maintenance, all those types of things that come up. And it's a little bit more lumpy than rent because some of those things you just don't have maybe in a given year. You don't have repairs, you don't have maintenance, but all of a sudden you can have them in big chunks sometimes. And that's kind of the other thing to kind of think through. A lot of times, this part of it, the cost side of it, I found clients, they might think about some of the basic explicit costs like, oh, what are my taxes? What are my insurance? Repairs and maintenance is one that I see people disregard or really underweight. And it might be because for a couple of years, they don't have any. And it's like, it feels like there's not a whole lot of downside. And then all of a sudden there's one big repair and you realize, wow, if I do the math, that just really degraded my return over the past 3 years when I do the math over and average it out.
Yeah. And kind of extrapolating that, where we talk about investors with multiple properties, cash flow from multiple properties. If one bad thing happens, you tend to have a little bit more incoming cash flow. You can spread your reserves around a little bit more strategically, which creates less of a, hey, all of a sudden I have this house and it's kicking me off income, but now I have to put a lot more money back into it. Did I think about the structure of that arrangement correctly? So I think that there's so many downstream implications, right? It's not just, hey, here's what the rent is and here's how much my mortgage is. Anything between the difference plus what I pay off in equity is an expected gain. There's a lot of small things you have to think through. And then that kind of gets to, you think about income, you think about costs, and then you kind of end up with a few different numbers that you can use to evaluate, hey, how profitable is this? And then from those profitability metrics, then you can kind of think about, well, how does that equate to return? So maybe just share some insight on some different profitability metrics that you get to after you think about income and costs.
Probably the most important one that we kind of measure for our clients regularly is cap rate. So this is the net operating income of the business or of the property divided by the value of the property. So it's pretty simple. You're basically just saying, what's my rent? What are the costs associated with it? Whatever, when I say the costs outside of debt. So the way you can think about cap rate is I'm going to go back to my $500,000 property. If I had a $500,000 check and I went and bought this property, what kind of net income am I going to get on that $500,000? After all my costs and expenses, well, how much do I get to take home? So it's an important number because it's something that you can use to evaluate against other types of investments. If I were to invest in a treasury bill and I put $500,000 in a treasury bill, what's my yield? What am I going to get in a return? So cap rate is something, again, that you want to look at, and that could be used as a comparison against other investments, basically, to say what other kind of returns would I be getting in other investments compared to this. So cap rate wise, I would say, we love to see cap rates in the 10% range because then you start, you're basically approaching equities. I would say we rarely see that these days. So, realistically, cap rates more in the 5% range, maybe a little higher would be a good place to be. I will say there's many times we do analysis and we see cap rates at 2%, 1%. And it's again, to your point before, when you see that, you are essentially just focusing on price appreciation. That's what you're saying is, I'm not going to make any money on the rent. So I'm hoping, it's a hope strategy. I'm hoping that the value of this property goes up significantly over time. So I think that's probably an important factor to think of. Realize too, if you have a cap rate at 1 or 2% and you are using debt to finance this property, you are going to be cash flow negative because the cost of finance right now is maybe 7%. And you are only earning 1% or 2% in yield on the property. So you're going to be losing money. Now, you might say that's okay because I think I'm making it up in appreciation. But every year, you're going to have money going out the door, basically, between all of your costs and your debt financing. So I think that's an important factor when you look at that is you should probably do an analysis to say, how much does this property need to appreciate for me to actually start making money on it? And how much does it need to appreciate, not only to start making money, but to also actually have a decent return compared to what I might be able to invest in other areas?
Yeah. And this is a situation where leverage tends to help. Leverage also gives you insight into your hurdle rate, right? Like your expected return kind of has to be above your cost of financing. Otherwise, the math is not gonna work out. But that helps you do a bunch of different things. How long is it going to take me to break even on my investment? It's a classic one, right? Like held in here. The other one I think gets a lot of focus is building equity in the property over time as something that people, including myself, hey, don't discount the fact that every month I get $700 more equity. So that's another way people are viewing these different analyses.
Totally agree. I think that's got to go into your analysis of, yes, you might be underwater cash flow wise, but you can almost look at it to some degree as an investment that you're just putting against the equity. So you'll eventually hopefully get it back. And based on typical loans, the amortization, you won't see a whole lot of building of equity in the beginning because most of your mortgage payment is going towards interest in the beginning, and it starts to it starts to increase as far as how much is going towards principal down the road. So if you're going to use that approach of looking at equity, obviously you're going to want to have an amortization schedule to look to see how much am I building in equity over time, and factor that into your break even as well. So when we're doing our analysis, that's typically what we're looking at, is not just the income but also the equity, because you have to look at both. A few other things that I wanted to touch on here because they're just unique, and we talked about them earlier in the podcast, but I do think it's important to talk through, which is some of the tax advantages of real estate that might be a little bit different than what you would get if you were, again, using my example of comparing it to just investing in a treasury bill or investing it in stocks. And so the three big ones on the tax side are, first, depreciation. When I buy a property as an investment, I'm able to depreciate the property over its useful life. And that, for real estate, that tends to be about 30 years. So I could take about 1/30 of the value of the property each year and deduct it against any income that I have on that property. So where that's really advantageous is if I'm earning income on my property, and I normally would have to pay tax on that income, I can shield it by using some of this depreciation, because depreciation is a tax item, but it's not a cash item. I don't have to actually pay anything for it. I just get it as something I can depreciate. So I think that's an important factor when you're looking at income. A lot of times income with real estate tends to be, I don't want to say it's tax-free, but it's, you don't have to pay tax on it, let's just say today. Now, what's happening behind the scenes when you use depreciation? Well, if I have a property that I bought for $300,000, and every year I can depreciate, let's say, $10,000 of that and use it against my income, after 5 years, I'll have depreciated $50,000. My basis in the property, what I paid for it, is now not 300 anymore. It's actually 250. So I'm just reducing the basis of my property. Why does that matter? It matters when I go to sell it. I have to recapture that basis. So I think that's an important factor, is that I'm getting some tax benefits now, but I'll have to pay for it later when I sell. So that's number one, I think, in the tax side of things. So you can kind of accelerate a lot of tax benefits, even though maybe you'll have to pay for them later. So there's a time value of money in that. Let's just say part two to that is that I have a property that maybe has been fully depreciated. I've owned it for 30 years. And I get to the point where I say, wow, I really don't want to own this property anymore. I'd love to upgrade to a better property. I'd love to own a bigger property that has more rental income. But I'm going to have to sell my property, pay all this tax because I have no basis in the property. So now maybe I have to pay, $100,000 of taxes to be able to take the proceeds and go buy another property. Real estate offers kind of a unique opportunity called a 1031 exchange, where you can exchange one property for another like-kind property. And by doing that, I don't have to pay the tax. So I can kind of upgrade my property, if you will. Now, it doesn't mean that I get new basis in the property. I have to take my old basis, which in my example was 0, and transfer it to the new property. But it does allow me to, if I want to sell Apple because I think it's a great, it's had its run, and I want to buy Johnson & Johnson, Well, there's a tax impact that I have to take to that if I'm buying and selling stocks. With real estate, I can do it tax free as long as I follow some guidelines. Maybe if we have enough interest over time, we'll have a whole podcast on 1031 exchanges because it's actually a very interesting topic. But just know that it is opportunity available that you don't have with other investments.
That's the exact phrase I expect to come out of the son of a CPA is we can have a whole podcast on 1031 exchange if they're interesting.
Yeah. There's one other on the tax side, just before we move on. One other thing I wanted to mention, and we have clients in both these camps, but the IRS has a very important distinction on how you invest in a property and how you're classified. Are you an investor or are you a dealer? And so I think it's important to understand the differences there and then what that could mean from a tax perspective. So are you a dealer? That basically means, is this your profession to a large degree? Are you using real estate as like your inventory because you are maybe I buy 150 acres and it's commercially and I'm going to parcel it off and sell it off and this is my investment, but I'm actively soliciting, I'm actively marketing it, I'm actually actively improving, developing the property. You can make the same argument potentially if I'm buying real estate and fixing it up and that's my business, that's what I'm doing. The IRS will likely view you as a dealer. The benefit of that, and so, well, actually, let me give the second option would be, are you an investor? So this is more of like, are you more of a passive investor in real estate? I'm just buying real estate. I'm hoping for it to go up in price. I'm collecting rent, all the things that we've been talking about. Most of the things we've been talking about are investors. So what's the difference? The difference is if you are a dealer, the income and expenses are considered actually ordinary kind of regular income items for you. So if you have losses, which happens a lot in real estate because of depreciation, you can actually use your losses against your income. That's an important distinction. If you have losses and you're an investor, you cannot take your losses and offset other income with that. You're considered passive. They don't let you do that. Now, also when you buy and sell, you're getting capital gains as an investor. When you're a dealer, it's more income. So there are important distinctions, and there's all sorts of people that try to challenge the IRS on this based on what will favor them. But I think it's important when you're thinking about doing the underwriting on the property, you also want to think about taxes, and you want to look at your after-tax return. And an important distinction will be: are you an investor or a dealer?
Yeah, this is what nobody tells you when you think about getting into finances. You think it's all about being a great business person. And then you learn, hey, this is really about accounting and legal. And those things oftentimes are not quite as much fun as reading a book about a business person. Should we jump into an example? Is there anything else you want to?
I think it'd be a great time to kind of take all the stuff we've been talking about and maybe try to apply it to an actual kind of real life example.
Yeah. And probably the person we should use as a guinea pig most is me. I just went through it. And I went through it with some of these unique attributes, right? I think anytime you evaluate from an investment, you should do so at the very beginning from a clean slate. So the first thing you want to do is say, hey, if I have to pretend as if I'm going to buy this house, even if I already own it, because what you're really doing is you're making another decision to keep owning it. And this is the thing about investments. You kind of have to make these choices all the time, right? I'm going to decide to continue to pursue this strategy, or I'm going to decide to do something different, but still doing something. Oftentimes, if you do it right, is an active decision. Another approach is just ignore things. Don't recommend that one. But so the first thing you want to do is say, hey, I'm going to look at this from a clean slate objectively. The second thing is something I mentioned at the very beginning, which is there anything unique about me? And this is the hardest part about investing, is the humility to say, I'm not that unique, right? So I have this property. Something that's unique about it is I have a really low mortgage rate. That was a unique thing that not everybody else has. And that was probably my one unique attribute. You might make an argument that I had a townhome in a decently competitive place in Winston-Salem. So this is a small college town. A lot of people are moving there from the north, pretty sought after, tends to be bidding wars. Downside, there was bidding wars everywhere in 2021, so I'm not really sure I could view that as that unique. So then you go into an analysis where you kind of think about exactly what you talk about. Let me look at my purchase price. One of the things that you mentioned, Pat, was a lot of the metrics we use are relevant to the value of the property. In real estate, value is not reflected every day like it is in stock markets, right? So here's where I tend to see, and I caught myself doing this, being a little picky about what number am I going to use? Am I going to use the price I paid, or am I going to use the expected value of the property today? It matters from some of these metrics. And this is where you can see the challenge of, oh, well, it's this, I don't know. And you kind of cherry pick and jump between the two. So you think about, here's the price I pay. Do I have to incur any costs to get it ready for market? Long story short, we decided to not rent it out. We sold it mostly because I needed the down payment to buy another house as a primary factor. But when I bought my new house, the sellers definitely had some work that they had to do of a pretty significant dollar amount to get the house ready for us to buy. So there oftentimes is work that you put off and you don't quite recognize. So we're going through, you have the prices that you're kind of paying, you have the financing decisions. Again, this is kind of an asset, so we think. And then here comes a lot of these different assumptions that have to be made. And this is where, again, you want to be really, really conservative, right? So what's the true rent that I can get? And this is, again, a spot where there's a ton of information out there in the marketplace. You could go to Zillow and say, hey, I'm looking for rental properties. Let me look at some options and see what people are listing them for. So go in, find what we think is a reasonable comparison. Challenge of already owning a home is I probably thought it was a little better than maybe it would be to the next person, right? Like, I love that house. Vacancy is a really tough one. I think you can, again, we kind of reference that. And then all the costs, right? And I think there's kind of two hidden costs. The first is the repair cost that you mentioned. What happens if something goes wrong? How do you think about building some reserves to pay for that? The second is we didn't live in the state, so we only have one option, which is property management. But it tends to be about 10%. That's a pretty significant cost that you're going to have to pay in exchange for not taking on headaches. That 10% is going to matter a lot in your ability to make money on the property relative to the opportunity cost. So you think about all these costs, and then this allows you to do some of those metrics that we were talking about, right? So what's my net operating income? It's positive. It looks like a great number. I think this is one of the big traps is you're looking at, hey, what's my mortgage? What do I pay versus what do I get in rent? And that's where you tend to see some pretty big, nice numbers that look great. When you zoom in and you think about some of those costs, the cash flow doesn't look quite as great. Even using leverage, the cash on cash return, not as great. Cap rates were around 3%. So you kind of mentioned like, hey, this is what we're seeing. With a low mortgage rate, you're still kind of targeting a 3% mortgage rate. The 1% rule, we were at half of that, which kind of just tells you price appreciation. And so if you can't make the numbers work on a spreadsheet, that probably tells you a lot about you're trying to force an investment. And when you listen to all the greatest investors out there, they say things like, we turn down 90% of the things that we look at. Why? Because it is so hard to find something that the market hasn't already priced in. And again, you go back to, hey, what was the theory? What did I expect? I kind of expected this outcome. Opportunity cost. Could I have put the money to better use? Yes, I could, because my family would like a place to sleep. So just one example, again, about 10%, over 100 clients of Greenspring have direct invest private real estate. The numbers, you want to be very thoughtful and work hard to think about those. And then you want to think about what are those other extracurriculars, because at the end of the day, money's not just dollars, right? Is it an investment, or am I going to get some alternate use out of it? Am I going to be able to allow my kid a place to stay? Am I going to be able to vacation there when I'm not renting it out? These types of things are going to come into play after you look at the numbers.
Yeah, it's a great, thank you for sharing the kind of your specific circumstances. And it sounds like you came to the conclusion that the returns were not commensurate enough with kind of the risk that you were going to have to take, along with, other competing sources of capital that, or competing investments for your capital. I think it's the conclusion that you got to, we talk about how many of our clients invest in real estate. Well, there's another element to it, which is there's a lot that don't. If about 10% do, then that means 90% have not decided to. And I think that's an important number to think about too. It's not that there is a right or wrong answer with this, but you do also have to kind of know yourself to a degree. And owning real estate is not a passive investment. I mean, I think people have heard that before. It really isn't. You have to be willing, even if you have a property manager, to deal with properties. I have a family member that owns an investment property that is managed by a property member, and I can tell you it is the least thing from passive that you can think of, because they're getting calls all the time about repairs that need to be made to the property. Now, they may not have to do them all, but the part of the brain that has to kind of just deal with the decision making all the time of what do we do? Should we make this repair? Oh gosh, this person's not paying rent. What do we do? Do we have to evict them? There are just these decisions that have to be made that a lot of times people don't want to make them, or they look at the returns and say, it's not worth it for me to have to deal with this. So again, there's not a right or wrong answer. I think you had some really good insight in that if you are going to decide to invest directly in real estate yourself, you should think about what's kind of my competitive edge here. What do I have that can make this a really good investment? And it could be maybe you're in a great area that you know really well and has great numbers when you do the underwriting. It could be a low mortgage. It could be you already own this property and there's some advantages to it. There's a lot of different things. But if you don't know and you're just like, I'm just thinking of, buy a property to rent it out. And, one, do the underwriting. If the numbers don't make sense, there's a really high likelihood that it's not going to work out very well. So, just make sure you're mindful about investing before you jump into it.
That's right. And, one of the examples you gave is we work with a lot of real estate developers. We work with a lot of smart people in private equity. And when you see their returns on Excel, they know it's really hard to get those on a one deal thing. First year is pretty easy to model out. After that, there becomes a lot more uncertainty, right? So this is one of the reasons why you think about, hey, their expected return number, it's bigger than the realized return they're actually expecting to get, right? Doesn't typically work the other way. And this gets into the nuances of returns with skewness and volatility. But it is very helpful to have a significant dose of skepticism around, hey, what's the true risk equivalent to my investment? And if I'm using leverage, comparing it to something with maybe less leverage, I think that's an important consideration. So what's the true risk equivalent? And then how do I factor in challenges unique to me? Like, am I taking on illiquidity? As an investor, I should want higher return in exchange for less ability to access that, unless it's such a small portion of my net worth that I disregard, which tends to be the opposite for people. If you go back into why do people get so attracted to real estate, it's because the use of leverage can really amplify your ability to grow your net worth if everything triggers exactly right.
Absolutely, yeah. I think it's a good place for us to end, and maybe we'll have a geeky conversation about tax-free exchanges at some point in the future if enough people have an interest in that. But it was a fun exercise going through. I think it's a question that a lot of clients have. And, if you're a client of Greenspring, I would say, and you haven't gone through the analysis with your advisor, I would encourage you to have these conversations, because we do this every day. And if you're not a client, you want somebody to take a second look, we're happy to help.
Yep, absolutely. All right. Thanks, Pat.
Thank you.